And he is often a contrarian. He is usually a central bank critic, and he always has a lot to say, and likely has a lot to say about all this rubber band stretching. Marc Faber, author of the Gloom, Boom, and Doom Report. Great to have you here on.
Well, it's very nice to be in New York, in my great empire.
Yeah, because you're coming from Thailand, right?
I was just telling yesterday some colleagues of mine at the Barron's Roundtable that if I would say about China what I'm saying about America, they wouldn't let me into the country. But here, when I arrive, the immigration officers, they hug me. They say, welcome to the United States.
Me and everyone else,
we don't need to check you. We trust you. You don't need to go through security.
But you said a lot of stuff, and we want to get into some of the new things that you're saying right now. We're just talking about, you know, how far can this rubber band, so to speak, be really stretched? In other words, at what point do we hit the law of diminishing returns? We get a Fed that's been so accommodative. When does it backfire?
Well, we have to distinguish between the financial economy, the financial sector, and the economy of the well-to-do people that benefit from rising asset prices, from rising prices of wines and paintings and art and bonds and equities and high-end properties in the Hamptons and West 15 here in New York and so forth. And the average person, the typical household, the so-called median household, or the working class people. And the Fed's policies have actually led to a lot of problems around the world, in the sense that they're not only responsible, but partly responsible that energy prices are where they are. They're up from $10, $12 in 1999 to now around $100 a barrel. And food prices are up, and a lot of other prices are up. So on your income, energy prices have very little impact, because you at Bloomberg and you young man, you make so much money. But for the poor people, it has an impact. Some people in the lower income groups, they spend, say, 30% of their income on energy, transportation, and so forth, electricity and gasoline.
So the Fed is creating a two-class system?
Correct, largely. And the problem is then that you have people like Bill de Blasio, they come in and say, you know what's the problem? All these rich guys. Because of these rich people, you are poor. They take advantage of you. So let's go and tax them. And the IMF has come out with a paper in Europe that essentially the well-to-do people should pay a 10% wealth tax, a one-time wealth tax. But I can assure you, one-time wealth tax, 10%, will become every year's tax eventually.
But from the point of view of the government, I mean, what low rates in theory should help people who need to borrow or put kids through college. I mean, how do you help the people on the lower end?
Well, this is the point I'd like to make. All these professors and academics at the Fed who never really worked in the private sector a single day in their lives and write papers nobody reads and nobody's interested in, why would they once not write about how do you structure an economic system that lifts the standards of living of most people? You can't lift everybody.
You don't think we have that, Mark?
Well, we had it in the 19th century in the US because we had very small government. At the time, the entire government, local, state, federal, was less than 20% of the economy. Now it's like close to 50% of the economy.
So the government's spending too much money.
The larger the government becomes, the less economic growth you have, and the more crony capitalism and corruptions you have. Because big corporations, and especially the money printers, they're the most powerful people in the world. They control the governments. The US Treasury, the Federal Reserve, and the government is one and the same. The Fed, they finance the Treasury, so the government can go to war in Iraq and Afghanistan. Then they finance transfer payments to essentially buy votes so you can get elected.
So let me just ask you, because we've done a lot of reporting here on Bitcoin on Bloomberg TV.
Yes.
Given what you just said, what do you think of Bitcoin?
I prefer physical gold and silver, platinum to Bitcoin. Bitcoin can have a lot of competition. Gold and silver and platinum, they have no competition.
They've got Bitcoin.
Well, they have Bitcoins, but how do you value a Bitcoin? I can value gold to some extent and compare, say, gold to the quantity of money that is floating around the world, to the wealth increase, and to the monetary base increase, to the credit increase, and so forth and so on. So I have a fair, and to the production cost. So I have an idea where gold should be. I'm not sure, because prices overshoot. How do you value Netflix? Is it overpriced or underpriced? Is Tesla overpriced, underpriced? But one thing I wanted to show you and talk about, because you said, well, lower interest rates help people. Well, if money printing helps everybody,
right,
then why does not everybody in the whole world always have zero interest rates and everybody would be rich? Well, and you keep on printing money, and we all, you don't need to work here, you don't need to put on makeup, and I can stay in bed the whole day until I go drinking in the evening. So let's just print money and be all happy.
Well, I tell you what,
I mean, it doesn't add up, you understand?
Yes.
And one thing about what the figures you showed, first of all, you live in New York.
Yeah.
Do you really think that your cost of living increases are 1.2% per annum? Do you really believe that?
Feels like more.
Well, it doesn't feel like more. It feels like 5 times more, precisely, or even 10 times more. Okay. That's what it feels. Number two, by keeping interest rates at 0% on the Fed fund rate, and I want to emphasize that this is now going on in March of 2014 for 5 years. So it's not something new. For 5 years this has happened. You penalize the income earners, the savers who saved your parents. Yes. Why should your parents be forced to speculate in stocks and in real estate and in everything under the sun?
When what they really want is a return for bonds. We've got to take a very quick break, Mark.
Yes.
We are glad you're here.
This is very sad.
We're going to be talking about income indisparity and specifically what you want to short right now, what you don't like. We are here with legendary investor Marc Faber, and we're talking about stocks that are overvalued on your list: Facebook, Tesla, Twitter, Netflix, Viva. I can understand Tesla and Twitter, right? I mean, they're not even earnings at Twitter. Why Facebook, though?
Well, I think it's to a large extent a fad. And, you know, people, they go on Facebook. It's, for most people, what people do is they put the pictures on, and the only people that watch these pictures are themselves. They all want to be stars. It's a very distractive kind of occupation. I can't imagine that this would have a lot of value. So, look, I'm not sure.
But if they're monetizing it, so people are going on, and regardless, they're going and looking at their own pictures, their friends' pictures. But Facebook can appeal to them through an advertising campaign and be very direct.
In other words, right. What's wrong with eyeballs?
Yeah, sure. Look, can be. The question is of how much use it is. I would rather own. I don't own it because I think it's very highly priced, but I would rather own a company like Alibaba or Amazon or Google than Facebook, personally. But this is my view. Other people have different views. That's what makes the market. Some people are buying it and some people are selling it.
You named a number of stocks, but when you look at the market valuations overall, do you have some concern? Do you worry when the Fed steps back?
I think we are in a gigantic financial asset bubble. But it's interesting that despite of all the money printing, bond yields didn't go down. They bottomed out on July 25th, 2012 at 1.43% on the 10 years. We went to over 3%. We're now at 2.85% or something
still
thereabout.
From your view.
But we're up substantially. Now, this hasn't had an impact on stocks yet. In fact, it pushed money into the stock market out of the bond market. But if the 10 years goes to, say, 3.5% to 4%, then the 30-year goes to close to 5%, the mortgage rates go to 6%, that will hit the economy very hard.
And that's when the bubble bursts, theoretically?
Well, it can burst before, it can burst any day. I think we're very stretched. Sentiment figures are very, very bullish. Everybody's bullish. And the reality is they're very bullish because they think the economy will accelerate on the upside. But my view is very different. The global economy is slowing down because the global economy is largely emerging economies nowadays. And they're slowing down. There's no growth at the moment in exports in emerging economies. There's no growth in the local economies. So I feel that the valuations are high. The corporate profits have been boosted largely because of the fall in interest rates.
That is one of the reasons why you are long gold. Marc Faber, I wish we could keep this going.
Yes, I wish so.
Thank you for being here.
Well, it's my pleasure. Thank you.